Good evening, girls. So today let us study in detail what are the sources of external finance, or in other ways, what are the ways through which we get finance from foreign countries or from outside India. So let us see what are the sources of external finance. The first main source to obtain money from outside India is the World Bank. What is that? It is the World Bank. The name of the World Bank, we call it World Bank, but its name is International Bank for Reconstruction and Development. Understand? The name of the bank is International Bank for Reconstruction and Development, IBRD. But we call it as World Bank. Understand? Like nickname, we call it as World Bank. So this World IBRD and another association called as the International Development Association, IDA. So these two organizations, they together provide low interest loans, interest free credits, that means no interest at all, giving credits, and not only loans and credits, it also provides grants to developing countries. So this World Bank or the IBRD along with this IDA, they provide low interest loans, interest free credits and grants to developing countries. They also provide, not only do they provide financial assistance, they also provide economic advice and technical assistance also, and they serve as a catalyst to investment by others. So not only they help, but they encourage other countries to make investment in our country. So they act as an catalyst, mean they act as an a bond between, they create relationship between other countries with developing countries, so that the developed countries also make some investment in the developing countries. So this is the role of World Bank, and this is how we can get grants, loans from World Bank. The second is regarding India. Regarding India, the next major important source where we get foreign capital is the Asian Development Bank, the ADB. This bank, as the name says, this is a bank which is related to Asia, Asian countries. So all the Asian countries will be members in the bank, and the bank will be helping all its member countries. Understand? So India being situated in the state of Asia, we are the member of Asian Development Bank, and we get help or loan facility from ADB, that is the Asian Development Bank. This ADB, that is the Asian Development Bank, assists its members. Understand? As I told you, its members, not every country, only the member countries only. How it is giving the assistance? By providing loans, by providing technical assistance, by providing grants, by providing equity investments, and to promote social and economic development. So what is the aim of Asian Development Bank? The aim of Asian Development Bank is to promote social and economic development. How it is promoting social and economic development? By providing loans, technical assistance, grants, equity investment, etc. to its member countries. The Asian Development Bank maximizes the development impact of its assistance by providing advisory services and mobilizing financial resources through co-financing operations. What is co-financing operations? Joining hands with some other developing country. Take for example, you give 50%, I give 50%, like that. It makes some agreements with other countries and providing this co-finance facility also. So it is mobilizing financial resources through co-financing operations that tap official, commercial and export credit sources. So through all the sources, that is official means it makes an agreement with the government of some other country to provide loans to some other country. So official loans. Then commercial, It encourages the business in one country to invest money in other country, developing country, so commercial. Not only that, it also provides export credit sources also. So next to World Bank, we studied that the second major source for external finance for India is the Asian Development Bank. Then the next is export credit. What is export credit? Export credit is a loan given to a person or company who exports goods while they wait for payment from the buyer. See, imagine a person is exporting goods from India to some other country. So the person who is exporting, so he invests all the money, and what he does, he makes the production, he makes completes the manufacturing process and make it as finished goods, and he is exporting. So it takes time for the goods to reach the hands of the importer, and he has to accept the goods, verify the goods, inspect the goods, buy the goods, take it in his storehouse, and then he has to make the payment. So this exporter of our country has to wait so long. And our country people, when they cannot wait so long because we do not have much resources. So export credit is nothing but the credit or the loan given to an exporter during the time he is waiting for getting the payment from the importing country. Understand? So, a credit or a loan facility given to a person or company who is exporting goods and waiting for payment. Understand? So, that is called as the export credit, and this export credit is of two types. One is pre-shipment finance and the other one is post-shipment finance. By the name itself, you can understand shipment is nothing but shipping the goods, sending the goods. Pre-shipment finance is getting loan for work related to before shipping the goods. And post-shipment finance means getting financial assistance for finance requirements after shipping the goods. Understand? Let us see what is that. Pre-shipment finance refers to the financial assistance provided to the exporters. Understand? As I told you, before actual shipment of goods. So before shipment is made, the exporter needs some money, some loan facility. So if the exporter borrows a certain finance before shipping of the goods, that is called as pre-shipment finance. Understand, girls? The next is post-shipment finance. See, here it is given, a few lines is given about pre-shipment finance. It is provided for the purpose of purchase of raw materials, processing of raw materials, and converting the raw materials into finished goods and packing them. Understand? This is pre-shipment finance. Before shipping the products, what are the requirements? So for this requirements, the exporter is getting some loan, that is called as pre-shipment finance. It is provided for the purpose of purchase of raw materials, processing and converting into finished goods and packing them. That is why this pre-shipment finance is also called as packing credit. Pre-shipment finance is also called as packing credit because up to packing, the finance support is provided. The second one, post-shipment finance. What is that? Post-shipment finance is any loan granted to an exporter of goods from the date of shipment of goods. That is after sending the goods in the ship. After the date of shipment of the goods. So from the date of sending the goods to the date of realization of the export profits. That means the date when you get the money from the importer or from the buyer in the other country. Understand? So this is called as post shipment credit because the credit is availed after shipping the goods and up to the time of waiting for the money to be received from the buyer. So up to that waiting time, he cannot wait, he needs urgent money. So he is provided finance. That finance is called as the post shipment finance. So it is very clear in the study material. See, Post-shipment finance is any loan granted to an exporter of goods from the date of shipment up to the date of realization of the export proceeds. This is provided to safeguard the exporter to fill the gap of credit period he has extended to the buyer. Take for example, he might have given 2 months credit or 3 months credit, exported the goods for 3 months credit. But he has exported, he is in need of money for the next manufacturing process, etc. So at that time, he can obtain loan for post-shipment finance. In post-shipment finance, during the period of the credit availed by the buyer. Understand? Okay, so this is the third one, export credit. So this is the most common form of credit. See, instead of getting loan from others, here we are getting loan for export. So that is very good, isn't it? So the next one, fourth one is remittances received from Indians working abroad. We get money. Remittances is nothing but receipt. Receipt of money from Indians who are working abroad. So our country people who are working abroad, they make certain payment to our people, his relatives, his or her relatives in our country. So Indians working abroad, they have kept India's current account deficit within manageable limits. They only keep the foreign capital reserves because they earn the money there in foreign country and they give the money or deposit money in Indian Indian banks because their families are here in India, and that helps us, that gives us more help in, that brings us foreign source of capital. Understand? So this is the money sent by someone working abroad to their family back home in India. The largest sources of remittances have been Indians working in the Gulf countries. Understand? So most out of the people, Indian who are working abroad, most of the people are working in Gulf countries. So the major portion of money coming inside our from under the heading remittances from abroad is from Gulf countries. The next is external commercial borrowings. What is that? Borrowings, borrowing for business. Since we borrow from a foreign country, we call that as commercial, external commercial borrowings. Okay. So what does we call that is in short in as ECB. This ECB refers to borrowing of funds by Indian companies from foreign sources. Understand? Borrowing a fund by Indian company from foreign sources in the forms of loans or bonds or any other instruments. ECB. What is ECB? External commercial borrowings can be obtained from foreign banks or international financial institutions like our World Bank, Asian Development Bank. We studied, isn't it? So they are all international financial institutions. So we can borrow from banks, foreign banks, or we can borrow from such international financial institutions. It can be in the form of rupee denominated loans. We can borrow money in denominated in rupees and paid in rupees or foreign currency denominated loans which are repaid in foreign currency. So we can external commercial borrowings need not be in rupee. It can be in any foreign currency. It can be in Indian currency or it can be in foreign currency. The money can be repaid in Indian currency or it can be repaid in foreign currency. The next is foreign institutional investors. Foreign institutional investors. A foreign institutional investor, shortly called as the FII, is an institutional investor investing in a country outside the one in which it is registered or headquartered. So what does that mean? A foreign institutional investor means it is an institution located in a foreign country but investing in our country. Understand? So any institution which is making an investment in a foreign country, it is called as foreign institutional investor. So a foreign institutional investor is an institutional investor investing in a country outside of the one in which it is registered. So in which country it is registered. So there it should not invest, it should make the investment in some other country. The term foreign institutional investor is probably most commonly used in India. In India, how do we use the term foreign institutional investor? It refers to outside entities, as I told you, companies in other countries, outside entities investing in our nation's financial market. So a company or an organization or an institution situated outside India making an investment in our country. That is what we call as the FII. So a foreign institutional investor is an investor in a financial market outside its official home country. Foreign institutional investors can include pension fund, investment bank, hedge fund and some mutual fund. So the investment may be in any form. They can make an investment here in our country's mutual fund, our country's pension fund, our country's bank. They can make an investment here in our bank or anything like that. Some countries place restriction on the size of investment by foreign investor. They don't allow huge investment from foreign institutions because in the fear of dominating. That institution should not dominate us, isn't it? So that is why there are some restrictions, limitations for foreign institutional investment. The next is foreign direct investment. As I told you, in foreign institutional investment, we talk about institutions making investment in our country. Here it is foreign direct investment. See, in foreign direct investment, what happens is, it is a category of cross-border investment. Here also investment is made. Understand? There also investment was made. Here also investment is made. But in foreign institutional investment, there the foreign institutions, they buy shares or they buy bonds in our country. But here foreign direct investment, it is not like that. It is a cross-border investment in which an investor resident in one economy, that is an investor, he may be an individual or he may be an organization. He is a resident in another country but establishes or starts with or join hands a lasting interest. Lasting interest means for long, not for a short period. For a long period, he is having an interest over an enterprise resident in another economy. That is, he is having an interest means, what do you mean by interest? Buying more shares or starting a new company here or opening a new branch here in our country. So this is called as direct investment. See, not buying our country's share, but opening his own company's branch here in our country, or opening a new organization here in our country. So this is what we call as the foreign direct investment. So the investment may involve acquiring source of materials, expanding a company's footprint. What is a company's footprint? Wherever they have branches. So that branches may be extended here to our country also, India also. So company's footprint or developing a multinational presence. Earlier it could have worked in that country only. Now they have extended their business in our country also. So that is direct investment. When a company becomes multinational company, it makes direct investment in another company. FDI investors typically take controlling positions in domestic firms or joint venture, or what they do, they start their own business or they become partner to the business in our country. So when they become partner, that is what we call here it is mentioned as joint venture. When they have a agreement with our people and do a business. Understand? Do a business. So what will happen when they do like that? They will have certain controlling position. They will have control over our business and they are actively involved in the management of our business. When they become partner, automatically they will involve in the administration matters also. So this is what we call as the foreign direct investment. Next is non-resident Indian investment. As we studied about remittances coming from foreign countries, not only remittances coming to family, not only that, even when the family is not here, or apart from providing money to the families, the non-resident people, Indian people who are residing outside India, they make investment in our country, attracting a lot of FDI. Understand? This is also foreign direct investment, but the investment is not made by a foreign person, but it is made by our Indian people who is residing in foreign country. Understand? Our Indian person, Indian citizen who is residing in foreign country earns money there but makes the investment in our country. So this is what we call as the non-resident Indian investments. So this also has improved in the recent years. This makes investment in India highly valuable because we are developing. This is a time of rapid industrial development. So it attracts non-resident Indian to make investment in our country. There are certain ways how non-resident Indian can make investment in our country. Let us see that fast before we go to the next point. The first is they can make investment in the form of fixed deposit. Instead of their savings, what they have saved there in their country, instead of depositing the money in their country's bank, they can deposit in our country bank because they are our people, our citizens. So investing in fixed deposits in India is a safe way for an NRI, non-resident Indian, because putting the money in fixed interest helps to earn a fixed interest income. That is a fixed amount as income. So fixed deposits can be non-resident external fixed deposit or non-resident ordinary fixed deposit or foreign currency non-resident fixed deposit accounts. So they have different types of accounts, fixed deposit accounts for non-resident Indians with a slight difference in the category of each one of them. So to attract foreign direct investment, to attract foreign investment by non-resident people, our Indian government, Indian banking system has set up many deposit accounts to attract the foreign deposits. Then the another one is National Pension Scheme. So though the people are working there, our people working there in foreign country, after getting retirement, they may come back to our country. So what they do while they are working there itself, they contribute their money to pension scheme, National Pension Scheme. It is a long-term retirement savings scheme specially designed for non-resident Indians aged from 18 to 60. So they can save their money or they can contribute their money to the pension fund in these years. 18 years of age to 60 years of age, and after the completion of 60 years of age, they can get their pension. NRI, this is also for non-resident Indian only. Non-resident Indian can open an account with a minimum contribution of rupees 500 annually every year. From 500 to rupees 6,000 rupees annually, he can open pension fund. The third is equity. How he can invest, a non-resident Indian, how he can invest in our country? He can purchase equity shares of Indian company. Understand? Non-resident Indians may directly invest in the Indian stock market under the portfolio investment scheme. The central government has a separate scheme for non-resident Indians to invest in Indian share market under the portfolio investment scheme. And they can also invest in mutual funds also. Not only in equity, they can also invest in mutual funds. Complying with the regulations outside in the Foreign Exchange Management Act. So subject to the provisions or subject to the regulations given in the Foreign Exchange Management Act, any non-resident Indian can invest their money in mutual funds in India. Some examples of a mutual fund for non-resident Indian is given here. The Aditya Birla Sun Life Mutual Fund, L&T Mutual Fund, SBI Mutual Fund, UTI Mutual Fund, ICICI Prudential Mutual Fund, and Sundaram Mutual Fund are some examples where non-resident Indians can invest in mutual funds in India. Then another way of investment is also there, which many of our non-resident Indians are already doing. What is that? Real estate. That is, they buy land here in India. They earn the money there, bring the money to our nation, invest their money in our nation by buying land in our nation. So real estate is a stable investment. So never will the prices of land, never has it gone down. Always the price of land goes up, isn't it? So it is a stable investment with good long-term returns. So non-resident Indian can buy and rent out. He did not buy and put it idle. He can buy and he can rent it out for residential and commercial purposes in India. But he cannot buy agricultural land and rent it. He can buy only houses. That is why we call that as residential property. That is a house to live in, and commercial property, shop, etc. Shop, companies, business premises, etc. He can invest money in that and he can rent out. The other form of investment by the other form of investment by for is the bonds and non-convertible debenture. A non-resident Indian can make the investment in bonds, that is debentures, isn't it? And non-convertible debentures in India, including government securities in the form of NRI bond. That is, government specially issues bonds for non-resident Indians, which is called as the NRI bond. The three main bond categories are public sector unit, that is what we call as the public sector bonds, or non-convertible debentures, and perpetual bonds. That is, like equity share, lifelong we can have bonds, perpetual bonds. So a non-resident Indian can invest money in bonds of our nation also. The next is global and American depository deposits. Global depository receipt, we call that as GDR, and American depository receipt, we call that as ADR. So when a deposit is made, we give them the receipt, isn't it? Like fixed deposit receipt, we have global deposit receipt and American depository receipt. So GDR is, that is global deposit receipt, is a negotiable instrument that can be traded freely like any other security, like buying and selling of a share. This GDR can also be bought and sold. In the Indian context, to our country, a GDR, what do you mean by global depository receipt? A global depository receipt is an instrument issued abroad by an Indian company. So an Indian company issues an instrument called global deposit receipt, and this is bought by people from other countries. See, the purpose of global deposit receipt is to raise funds in some foreign currency and is listed. That share is also listed, or that GDR is also listed and traded on a foreign stock exchange. So in order to raise money from foreign country, foreign people also, an Indian company issues GDR. What is that? Global deposit receipt. So any person from a foreign country can buy this global depository receipt, thereby our country receives some foreign exchange. Understand? A holder of GDR can at any time convert it, that is, convert the global depository receipt into the number of shares it represents. So though it is a deposit made by a foreign person in Indian company, it can also be converted into shares. The holders of GDR, that is a person who has made a deposit and is having the GDR receipt, do not carry any voting rights. No voting rights. But he can get dividends. He can get capital appreciation. But he does not have any voting rights. Many Indian companies such as Infosys, Reliance, Wipro, ICICI, they have raised money through issue of global depository receipt. So what is global depository receipt? A deposit attracted by Indian company. Who is investing the money for global deposit receipt? Foreigners. So foreign people buying the global deposit receipt issued by Indian company, thus fund flowing from foreign country to our country. And the next is Supplementing this global depository receipt is the American depository receipt, shortly called as the ADR. So the depository receipt issued by a company in America, in the USA, it is known as American depository receipt. Understand? A global depository receipt can be issued, can be raised from any country, but American depository receipt is always issued by a company in the USA. These ADRs are bought and sold in American markets like regular stocks. So like regular stock, they are buying this American depository receipts or deposits. It is similar to GDR. It is also like global deposit receipt only. But the only difference is it can be issued only to American citizen. Global deposit receipt is issued by Indian company. American deposit receipt is also issued by Indian company. But global deposit receipt can be issued to any person in any foreign country. But American deposit receipt means the American deposit receipt is issued only to American citizens. Or fund is raised from Americans only, and it can be listed in the stock exchange of America, USA. Understand? The next is, finally, it is foreign currency convertible bonds, shortly called as the FCCBs. Foreign currency convertible bond. These are equity linked debt securities. See, both equity is also there, debenture is also there. It is a hybrid of both debenture as well as equity. This is a bond, but it can be converted into equity share. That is why we call that as convertible bonds. So these are equity linked debt securities that are to be converted into equity or converted into depository receipts after a specific period. So in the initial period, it will behave like bond. After the completion of certain, for example, after the completion of 3 years or 4 years as decided, it can be converted into equity shares. A holder of FCCB has the option to either converting them into equity shares or retaining the bond. He can have it as a bond, or he can give back the bond and get back equity shares. So the option is with the holder. The FCCBs are issued in a foreign currency. This foreign currency convertible bonds are always issued in foreign currency, and they carry a fixed interest rate which is lower than any non-convertible debt instrument. So it has a very low interest rate. This foreign currency convertible bond has a very low interest rate. This resembles convertible debentures issued in India. So like how we issue convertible debentures, like that, this is at the international level, the foreign currency convertible bonds. So these are the 10 sources of finance. So prepare well. Very important question in the point of view of your examinations. Okay, girls. Thank you, girls.